it's no need to partner with capital partners, and you're taking a lower profit, but you didn't have to share with the cash partner. So I think it works out. The benefit to the other side is that you've got cash that you're bringing to the table, and so you can be more attractive to a lot of sellers who just want cash now and don't want to work for another few years to see the benefit, and they're willing to accept the lower amount now to get cash in hand.
My understanding is that it seems like there are two ways of doing roll-ups. One is like you acquire companies and you own a big chunk or the entire company and you roll them up, right? The other one is what Sam K and you are doing, which is you talk to all these companies and convince them that, at one point we will do the EBITDA and all that. So why that seems a little bit, assuming that you have the capacity to convince these people, that seems a little bit easier. And like, what are the pros and cons of both? Like, is it a relatively newer concept? Uh, so I just
So
was
the
curious about.
the I just read an article by another company that was doing this in the oral surgery space. They rolled up 45 oral surgery practices in 12 states, and they did it with tracking stock. They took basically 10% of the deal, and then the owners of those practices got 90%, and they allocated it similar to how we're doing. And they've just recently raised $112 million in cash because they couldn't move at the speed that they wanted to, and they were having a hard time competing with other private equity firms. So I think that the two big differences are, number one, if you do it the way that they did, the way that Sam and I are doing it, then you don't need to go to outside capital. So you're able to effectively provide a significantly higher benefit in terms of participation and expected return for the companies that are coming in, because they're effectively buying into, like a private equity investor, into the roll up, and the capital they're using to do that is their existing business at a lower valuation, but ultimately expecting that everybody gets a significantly higher valuation, because a lot of them have seen private equity firms buy their friends and their competitors low and sell high, and have those people be very disappointed. So that's kind of that one thing, is that it's no need to partner with capital partners, and you're taking a lower profit, but you didn't have to share with the cash partner. So I think it works out. The benefit to the other side is that you've got cash that you're bringing to the table, and so you can be more attractive to a lot of sellers who just want cash now and don't want to work for another few years to see the benefit, and they're willing to accept the lower amount now to get cash in hand. And so that route, you're going to have to get a capital partner. You probably are going to be at the same or maybe less in terms of participation as what they would call a sponsor, but probably about the same. And the difference is that you've got to balance the interests of the capital contributors, the capital partners, and the companies you're buying. And you don't have, in my opinion, a unique selling proposition, because there's a lot of people out there doing that. There's a lot of money chasing those deals, and you can end up paying more for the practices because you get in bidding wars with other private equity firms because there are lists of all these things that you want to buy. So I'd say those, if you don't want to have a capital partner, you want to potentially have a slightly bigger piece of the deal, but maybe not, and you are okay with the potential loss of deals to cash buyers, you'll probably like the way that Sam and I are doing it more. If you are just looking for, I want to move as fast as possible, I want to be have no objections and not have to explain the deal, and I'm okay sharing with capital partner, then that's the advantage of doing it the other way. Is that helpful?
Yeah, no, absolutely. So what kind of capital are we talking about in a typical, if you are going the acquisition way, which is the normal way, I guess. So are we talking about 1 million, 5 million, or what are the amounts that is good enough for you to raise? And
Well,
also,
it's going to
what,
depend on what you want to buy and what leverage looks like, right? So if you're financing the acquisitions and you can get away with 10%, 5 million would buy you 50 million of assets. If you're just using it straight cash and you're not leveraging it all, which I don't think would be smart, then you're looking at 5 million buys you 5 million. So then what's your average acquisition going to cost is what I would say, and how many do I want to do in the roll up? And then that's going to determine your capital needs. So you basically say, I want to have 10 companies that I roll up, and then I'm going to spin them off because at that level, I've hit what I need. And the average cost is going to be $1 million. Then 10 companies times a million means you need 10 million in total acquisition capital. If you can finance 90% of it, that means you need to raise $1 million cash and then have some mezzanine or other capital in terms of debt that will come in with a 10% buy, and that'll get that'll be 9 million. So you only need to raise 1 million, but you do need to have the 9 million in place, or at least some amount in place, or someone who says they'll do it before you get started. Right. So that's going to determine what you need to start with. And, you know, 5 million is probably kind of the like where it's worth doing, in my opinion, because you have to pay to have all of the documents created and everything. So
right.
I'd probably do a $1 million, a $5 million raise with $1 million minimum, something like that.